Hello everyone. Today we're going to learn about debits and credits, and in order to get started we should open up a Microsoft Office Excel spreadsheet, or if you want you can just use pen and paper, or if you want you can just watch. Whatever seems easier for you, but if you've been struggling with debits and credits, I think you'll find this approach to be a little bit easier than maybe what you've seen in the past. So let's start off with talking about the accounting equation. In a non-corporation setting, the accounting equation, let's just establish that. Non-corporation, the accounting equation, how about if I just put this on the next line? Insert here. Okay, so we'll go accounting equation. For a non-corporation setting, the accounting equation is assets equals liabilities plus owner's equity. In a corporation setting, the accounting equation is basically assets equals liabilities plus stockholders' equity. So no matter how you slice it, whether you call it owner's equity, stockholders' equity, if this was a partnership equity, we can just call that last piece equity. Okay? So the bottom line is that we're going to be working with a non-corporation setting. So let me just get rid of the corporation situation there so we don't get confused. And now let me break down the assets equals liabilities plus owner's equity into a little bit more detail. Okay? So how about if I spell everything out? Assets equals liabilities plus, now let's break down the equity. We know from previous discussions that equity is made up of four components. We have capital, we have drawing or withdrawals. I personally prefer to use the term drawing. We have revenues, and we have expenses. So this is the accounting equation in more detail, and basically what I did is I just kind of blew up the equity section to show you the four components. So we know that capital and revenue have plus signs in front of them. Those two accounts make your equity account go up. Drawing and expenses, however, have minus signs in front of them, and they make your equity go down. So just a couple little tidbits associated with that. Okay? So we've been used to dealing with transaction analysis. We have seen the assets go up and down. We've seen the liabilities go up and down. But when we are working with the equity accounts, we only saw them go up. So even though we see that drawing and expenses will reduce equity, but those four categories, those four equity accounts, which I call the shopping cart accounts, those four always go up. We never see them go down until we hit chapter 4 and we start dealing with a topic called closing entries. But until then, assets go up and down, liabilities go up and down, but capital, drawing, revenue, and expenses always go up. Okay, so let's just kind of just mark that for us so we don't forget. So assets go up and down. We'll live on the wild side and put minus in front of plus for the liabilities, but capital always goes up, drawing always goes up, revenue always goes up, and expenses always go up. So just a quick little reminder of the rules that we learned while we were in chapter 1. Okay, we are officially in chapter 2 of our accounting book, and this is the material that we need to know in order to go forward. So what I need to do right now is I want to create a series of T accounts. Let me just create a general T account right now, just so you can see how it looks. It looks like the capital T. Nothing fancier than that. And what I want you to know is that each T account has a debit side and it has a credit side. So the debit side is always on the left and the credit side is always on the right. Without a doubt, always the situation. Okay, debits are always on the left, credits are always on the right. So let me just kind of put that here underneath so that you can see what I mean. So the debits are always on the left, the credits are always on the right. Think of Washington, D.C. You know, the D comes before the C. All right? So what I would like us to do is to create a series of 6 of these T accounts. So I'm going to copy this over here and do that again. I'm going to do this a total of 6 times. And for some reason, the top of my account is disappearing. We can fix that very easily. And then let me do this, save us some time. Let me just copy paste these accounts over here. So basically we have 6 T accounts in front of us. And what I will eventually do is I will take the 6 accounts that you see in the accounting equation, assets, liabilities, capital, drawing, revenue, and expenses, and I will fill these T's with those names. Okay? To start off with, we want to label the first account assets. And just to kind of get us started in the right direction, you kind of have to trust me on this. You know, as we're learning the words debit and credit, I've already mentioned that debit means left and credit means right. So left and right from a physical standpoint, but also, this is where students tend to get confused, debits can also mean up and down. And so could credits. So this is the confusing part of accounting. How can debit in one breath mean up and then in another breath mean down? Well, that's what today is all about. You're going to figure that out. You're going to see how that works. And the biggest comment that I have for you is simply, try to treat each of these accounts and rules that I'm sharing with you today, think of as if you're learning a brand new language. So let's say you kind of heard of some French words, but you're like, oh, I know what that word means in English. But then when you actually see it translated, it means nothing like it. Well, I want you to think of debit and credit that way. I know a lot of you people have debit cards and credit cards, and same thing with me. But what you right now think of debit and credit, you are so used to looking at things from your eyes. You're going to experience this little phenomenon today, which seems to be very, very common, and you're going to go, geez, I could have swore things were backwards. I thought it was the opposite. That's going to be a common thought that pops into your head. That's because when we do accounting, we're doing it from the company's point of view, not from the customer's point of view. You're so used to being the customer. So a debit to you is a credit to the company. A debit to the company is a credit to you. So what you thought was debit and credit in terms of definition, don't be surprised if it turns out to be exactly the opposite of what you thought. Okay? So let's get started. I'm going to label this first one assets, as I already have. And what I want to do is establish a rule, a baseline. So whenever you get stuck, you want to come back to this rule. And that is the way you increase an asset is by a debit. Whether you agree or disagree, irrelevant. In fact, I'm going to ask you, which is really strange for a teacher to say to students, and that is I'm going to ask you to not think for a few minutes. Just write it down. I'm not a big teacher when it comes to memorization, but I just need you to remember this one thing. A debit means up. A debit means increase when you're dealing with an asset. So if I ask you the question a few minutes from now, how do you increase an asset? The answer is debit. Okay? So now let's go over to here. And let's establish this category as liabilities. Now, in order to help us fill in this chart and define what debits and credits actually mean, I'm going to use the accounting equation that I established on the fourth row up here. Let me put that in green. Okay, so assets equals liabilities plus capital minus drawing plus revenue minus expenses. So let me ask you a quick question. Looking at that green equation, does everybody agree that liabilities rests on the opposite side of that equal sign compared to assets? And you're going to say, yes, it is on the opposite side. So I'm not going to be giving you any rocket science here. I'm not even giving you accounting science. I'm not even giving you math for that matter. All I'm saying is just because liabilities are on the opposite side of assets, we're going to treat liabilities exactly the opposite of the way we treated assets. Don't overthink it. Don't start thinking about this and this and that. Stop. Liabilities are on the opposite side of that equal sign compared to assets. Therefore, we're going to treat it the opposite of the way we treated assets. So by definition, the way you increase a liability is by a credit. So assets go up by a debit. So the definition of debit means up when you're dealing with an asset. When you're dealing with a liability, credit means up. Remember, debit and credit can mean up or down. It depends on what category we're dealing with. So far we've discovered that assets go up by a debit, but liabilities go up by a credit. And all I did was I just used that equation that we already know from Chapter 1. And all I said was, do you agree that liabilities are on the opposite side of assets? You said yes, so we're going to treat liabilities the opposite of the way we treat assets. That's it. Okay? Next one. Let's stay in this column, and let's call this one capital. I'm going to ask you the exact same question I asked you a few minutes ago, and let's see how you respond this time. Do you agree that capital is on the opposite side of that equal sign compared to assets? If you said yes, good, correct answer. So therefore, we're going to treat capital the opposite of assets. So if assets go up by a debit, capital goes up by a credit. Again, nothing fancy. I'm just using the equal sign that's in that equation to my advantage. Okay, let's stay in this column, and let's now label this one revenue. Guess what question I'm going to ask you? You got it. Do you agree that revenues are on the opposite side of that equal sign compared to assets? And the answer is yes. So revenues also work the opposite of assets. So just like liabilities, just like capital, and now revenue, these three categories go up by a credit. So credit means up for liabilities, credit means up for capital, and credit means up for revenue. Okay? And all I did was just use that equal sign. That's it. So now life gets exciting. Let's go over here and let's label this one drawing. And this category, if you notice, if we look at the green equation, it is also on the opposite side of that equal sign. But what does drawing have in front of it that liabilities, capital, and revenue did not? And if you notice the minus sign, good job. So even though drawing is on the right side of the equation, it's working against that side. It's working opposite of how that side goes up. Okay, so if I were to bring algebra into this discussion, and I said to you, how would I get rid of drawing if it was on the right side of the equation? You probably, those of you with some algebra experience, would say, well, I would add drawing to the right, and it would cancel out with the minus drawing. But what you do on one side in algebra, you got to do the other. So we want, by the time we're done, to have all pluses in front of these words. In order for drawing to have a plus in front of it, it would have to be on the left. Okay, so let's go back and look at it again. Yes, drawing was on the opposite side of equal sign, but it worked the opposite of this side. So in essence, it works like the left side. So drawing goes up by a debit. because it was on the right side, but it had a minus sign in front of it. So it worked opposite. It worked contra. It was like a negative on this side, and we want to see how it goes up. So it goes up by a debit. And the last category, expenses. Guess what the question is going to be? Yes, you got it. What side is the expenses on? It's on the right side. It's opposite of assets, but just like drawing, it has a minus sign in front of it. So if it has a minus sign in front of it, it's working the opposite of the right side. So in order for us to figure out how it goes up, we're going to have it go up by a debit. So basically, I just used this accounting equation to my advantage. I started with my baseline, with assets, and I said, hey, assets, definition of debit is up. And then I just used the equal sign to my advantage. Liabilities, capital, and revenue are on the opposite side, so therefore they go up by a credit. But drawing and expenses are on the opposite side, but because they have a minus sign in front of them, they work the opposite of the right side. So we end up treating them the opposite of how we handled all the other ones on that side. So they end up debiting, drawing to make them go up, and expenses get debited to go up. So there's the accounting rules. Now, just so you know, if you know how something goes up, you automatically know how it goes down. So an asset goes up by a debit, but goes down by a credit. Liabilities go up by a credit. These accounts go down by a debit. Okay. So assets and liabilities, just like in Chapter 1, they fluctuate up and down. I've got cash and then I use it. I buy some supplies and then I get rid of the supplies. I use up my equipment, things like that. So assets fluctuate up and down. So do your liabilities. I incur some debt, I get a bill, I make a payment towards the debt. So whenever I incur the debt, my liabilities go up. I would credit them. But whenever I make a payment on account, then my liabilities would go down and they would get debited. However, even though we can apply the same logic to drawing and the same logic to expenses, because if we know how these accounts go up, we automatically know how they go down. So I could technically put this in here, but if you recall, I referred to these accounts earlier as my shopping cart accounts. And if you remember, I said capital always goes up. So let's do this. Even though it technically could go down by a debit, until we get to Chapter 4, we will never see that happen. So I'm going to put a little blockade here for my 4 shopping cart accounts, because if you remember, capital always goes up. Revenue always goes up. Drawing always goes up. Expenses always go up. So that's why I call these 4 the shopping cart accounts. Remember I said, imagine you won a shopping spree and you get a few minutes to run through the store, and let's imagine you and someone else get to push 2 carts, a total of 4, and all you're doing is you're putting as much stuff in there as possible. So think of capital, drawing, revenue, and expenses as shopping cart accounts. You're just going through the shopping spree and you're just putting stuff in, stuff in, stuff in. Those shopping carts are getting more full as you are in this spree. Okay? But at some point, we will check out. Okay? And when we check out, we'll see these accounts go down. And that won't be until we hit Chapter 4 and we start dealing with something called closing entries. But until then, assets and liabilities go up and down, but your drawing, your capital, your expenses, and your revenue always go up. So a few little tricks of the trade. Okay? Remember that you always can't spell today. You always credit capital. You always credit revenue until we hit Chapter 4. Okay? We always debit drawing, and we will always debit expenses until we get to Chapter 4. So just kind of remember these. because that is set in stone while we're in these two chapters, or this chapter 1, chapter 2, and even chapter 3. Okay? Assets and liabilities fluctuate up and down. So remember the little symbols I put underneath the green row? I had assets plus minus. I had liabilities minus plus. Hey, it happens to match how we handled the T account. And look what I had under capital, a plus sign. What did I have under drawing? A plus sign. Under revenue, a plus sign. And under expenses, a plus sign. So basically, these are the rules of accounting. If you master these rules, you will have much success in the accounting world when it comes to journalizing, regular entries, adjusting entries, closing entries. If you know the rules, doing accounting or / bookkeeping will become easier for you. Let me give you a little trick that I've used over the years, probably for 30 years now, in helping my students remember these rules. And you'll hear me refer to these in future discussions that we have here, future recordings. And that is, if there's a certain pattern that some of these accounts follow. So let me give you a little trick. And I don't know what kind of a artist I am here, but in fact, you know what I'll do is, what if I were to find some clip art here, and let's say I want to find something that looks like this. So have you guys ever heard of lemonade? I'm sure you have. Have you ever heard of Gatorade? I'm sure you have. If you've ever heard of Powerade, yep. Well, I have a new drink, and my drink is called Debit. And I was hoping that I could put this in here just to kind of give us a visual. There we go. So if you can think of, lemonade, Powerade, Gatorade, like I said, I have my own drink, and my own drink is called Debit. Okay? And A for assets, D for drawing, E for expenses. So think of the term debit aid. A, D, and E. Okay, so if you can remember debit aid, man, you are in great shape, because the debit aid accounts go up by a debit. I don't know if it'll let me do this. Let me try something. Didn't let me do it. Let's see. Bring to front. Oh well. I guess I'll have to work on that. But think of that drinking mug to help you remember debit aid. So my first 10 years of teaching, I basically pushed this debit aid. A for assets, D for drawing, E for expenses. This little mnemonic device is just designed to help you remember how the assets, drawing, and expenses go up. So if I say, how do you increase an asset? Debit. How do you increase drawing? Debit. How do you increase expenses? Debit. So if you can remember these things, you guys are in great shape. Okay? Now let's think of the other side. We got to kind of use our imagination a little bit. But on the other side, I have liabilities, capital, and revenue. So for this side, we need to kind of, like I said, use our imagination a little bit, and I decided to kind of use the term liquor. And the word liquor is basically L for liabilities. It won't let me copy that. Oh well. Well, L for liabilities, C for capital, and R for revenue. So on this side, I have my liquor accounts. So it's just an easy way to help you remember L for liabilities, C for capital, and R for revenue. And we've got our debit aid accounts, we've got our liquor accounts. And let me just try one more time here. It just won't let me insert it. How funny is that? Never had this problem before. Copy and paste. Huh. Oh well, I've tried a few times, it's not working. So we've got debit aid and liquor. So every single time I am teaching accounting, I'm always referring to my debit aid accounts and my liquor accounts. So debit aid, A for assets, D for drawing, E for expenses. Liquor, L for liabilities, C for capital, and R for revenue. So if you can remember your debit aid and your liquor, remember debit aid and liquor are designed to help you remember how these accounts go up. Because if you know how they go up, you instantly know how they go down. Okay, so that's it for today. That's your debits and credits. Make sure you practice this, and the next time we're together, we're actually going to be doing some journal entries, posting, and then a trial balance. And we're going to be implementing this debit and credit stuff. Okay, have a great day. Bye-bye.